Welcome back to Charged Alpha. I'm Hudson Thomas, and today we're diving into what might be the most fascinating underdog story in all of biotech right now. Picture this. The GLP-1 obesity market is shaping up to be the single largest drug opportunity in a generation, maybe in pharmaceutical history. We're talking about a therapeutic category that Eli Lilly and Novo Nordisk have essentially printed money with. And yet there's a tiny 75-person company sitting in La Jolla, California, running a clinical program that could genuinely disrupt the whole race.
And Hudson, the numbers tell the tension immediately. The stock we're talking about is Viking Therapeutics, ticker VKTX, currently trading at $33.61. That's well off its 2024 highs above $100. But here's the disconnect. The analyst community, 18 firms covering this name, has a median 12-month price target of $96. That implies 186% upside. Either the street is dramatically wrong or the market is failing to price in something significant. That gap is the entire story.
186%. That's not a subtle, we think it's undervalued. That's a we think something is about to happen target. And something is about to happen because the Phase 3 data catalyst is measurable in months, not years.
Exactly. So let's unpack why. Let's get into what this company actually is, what's in the pipeline, the cash position, and whether the risk-reward here is as asymmetric as the analyst community believes.
Let's start with the basics. Viking Therapeutics is a clinical stage biotech, and I want listeners to hear that phrase carefully. Clinical stage. That means pre-revenue. They have not sold a single pill, a single injection, a single dose of anything commercially. $0 of product revenue in 2025. So this isn't an S&P 500 earnings story. This is a pure pipeline play.
Right? The company traces its roots to 2012 when it was spun out with intellectual property licensed from Ligand Pharmaceuticals. It's headquartered in La Jolla, California, about 75 employees total. Think about that for a moment. Hudson, 75 people. Lilly has tens of thousands. Novo has tens of thousands. Viking is running a pivotal Phase 3 program that enrolled over 5,600 patients across 2 trials with the headcount of a mid-sized law firm.
That's wild. And they're focused on 2 therapeutic areas: metabolic disease, which is where the obesity and NASH programs live, and rare disease, where their X-linked adrenoleukodystrophy program sits. 3 programs total, but make no mistake, VK2735, the obesity asset, is the star of the show.
It absolutely is. VK2735 exists in 2 formulations, which is unusual and strategically important. There's the subcutaneous weekly injection, which is in Phase 3 right now, and there's an oral once-daily tablet, which just posted Phase 2 data and is heading toward Phase 3. Then VK2809 is their NASH and MAFLD asset, a selective thyroid hormone receptor beta agonist with positive 52-week Phase 2b data. And VK024 is the rare disease program for XALD, which is a devastating genetic condition.
So why are we talking about this stock right now today? Because the clock is ticking on catalysts. Vanquish 2, that's the Phase 3 trial in patients with type 2 diabetes and obesity, has data expected in the 3rd quarter of 2026. That's maybe 4 to 5 months from now.
And before that, Hudson, Q1 2026 earnings drop on April 29th. That's literally days away from when we're recording this. Now, for a pre-revenue biotech, earnings day isn't about revenue surprises. There is no revenue. What investors will be watching is cash burn, R&D spend, trajectory, and any pipeline updates management chooses to disclose. The forward EPS projection for Q1 is around negative 95 cents. Even the base case here loses money by design.
And the stock has pulled back hard. We were over $100 in 2024. We're at 33.61 cents now. So there's been real pain for existing holders, and there's real skepticism baked into this price. The question is whether that skepticism is about to collide with positive Phase 3 data.
And that's what makes the oral VK2735 story so compelling alongside it. Oral GLP-1 is what the industry calls the holy grail. Every patient who's ever been on a weekly injection has wondered why they can't just take a pill. Viking's Phase 2 venture oral results last August showed up to 12.2% weight loss at just 13 weeks. Up to 97% of treated participants hit at least 5% weight loss. Those are remarkable numbers.
Let's talk about leadership. Brian Lian, PhD, has been CEO since day one. He's a co-founder, and the company traces its roots to his work at Ligand Pharmaceuticals, where he was before starting Viking. He's been named inventor on multiple patents, and he's taken this company from a concept to phase 3 NDA candidate over 14 years. That's not a flip operator. That's a builder.
And this is where insider activity gets interesting. Over the past 5 years, Brian Lian has executed 14 insider sales and 0 open market buys. On the surface, that looks bearish, but context matters enormously here. All of those sales were conducted under pre-planned Rule 10b5-1 programs. These are the automatic sell schedules founders use to diversify without any knowledge of material non-public information. In the last 6 months alone, he sold about 272,000 shares for roughly $9 million.
So is founder selling a concern or not? I can see both sides.
I think the honest answer is it's neutral to mildly negative, but not a red flag. A 14-year founder monetizing equity through a 10b5-1 is normal behavior. What's more interesting is what the chief commercial officer, Neil Abushan, did in March 2026. He purchased 4,475 shares at around $33.50. Small dollar amount, but the signal is loud. The person responsible for planning the commercial launch is buying at current prices.
And total insider ownership is still around 8.9% of shares outstanding. That's meaningful skin in the game. Okay, Lana, let's get into the numbers, but as you warned us up front, this is not your typical numbers section.
No, it is not. Throw out your PE mental model. Viking has no earnings. Throw out price to sales. Viking has no sales. The only traditional metric that's even remotely meaningful is price to book, which sits at 4.68 times. For a pre-revenue biotech, the relevant questions are, how much cash do they have? How fast are they burning it? And will the catalysts arrive before they run out?
So let's answer those. Cash and equivalents at year-end 2025, $706 million. Total debt, 0. That is a pristine balance sheet. Total equity of $847 million. Current ratio around 18 times. This company is not going bankrupt. The question is entirely about whether they generate a clinical win before cash pressure forces dilution.
And that's where the burn rate becomes critical. Operating cash burn is running at about $225 million a year. But look at the R&D trajectory. Full year 2025 R&D expense was $345 million. That's a massive jump from $101.6 million in 2024, more than triple. Q4 2025 alone had $153.5 million R&D because that's when Vanquish 1 enrollment completed, and you pay for a lot of the trial infrastructure up front.
Net loss for the full year was $358.5 million, or negative 3.19 cents per share. Q4 alone was negative lower 38. And interest income on that $706 million cash pile is throwing off roughly $30 million a year, which helps offset burn a little.
Runway is approximately 3.2 years from Q3 2025, which carries them into late 2028. That is enough runway to get through Vanquish 2 data, through Vanquish 1 data in 2027, and potentially to an NDA filing. But, and this is important, it's not enough to cover a full commercial launch. More capital will be needed somewhere along the way.
And here's the framing I want listeners to hold on to. Enterprise value, market cap minus cash, is about $3.25 billion. So when you buy VKTX, the market is effectively valuing the entire clinical pipeline at $3.25 billion. Is that a lot or a little?
For context, Hudson, a successful obesity drug, can generate $5 to $15 billion in annual peak sales. If VK2735 works, $3.5 billion for the pipeline is comically cheap. If it fails, it's wildly expensive. That's the binary.
For a company with no revenue, the question isn't what's the PE, it's how long can they run and will the data come in time? And right now, the answer to both is tentatively yes.
Let's dig into the pipeline properly, because this is where the investment thesis lives or dies. Start with VK2735 subcutaneous. It's a dual GLP-1 and GIP receptor agonist, meaning it hits 2 different incretin receptors simultaneously. That's the same mechanism as Lilly's tirzepatide, the molecule behind Mounjaro and Zepbound. Dual agonism has proven superior to single agonist approaches like semaglutide for weight loss.
And the phase 3 program is enormous. Vanquish 1 enrolled approximately 4,650 adults with BMI of 30 or greater, or 27 with a weight-related comorbidity. 78 weeks of treatment. That trial is fully enrolled. Vanquish 2 enrolled about 1,000 patients with type 2 diabetes plus obesity. That's the trial with data coming in Q3 2026.
The Phase 2 venture study that underpins all of this showed up to 14.7% weight loss at just 13 weeks with the subcutaneous formulation. For reference, tirzepatide showed about 15% at 72 weeks in its comparable trial. Viking hit nearly that in under a quarter of the time. That's why the Phase 3 expectations are so high.
Now, the oral tablet is its own thing. Same dual GLP-1 GIP mechanism, but once daily oral dosing. The Venture Oral Phase 2 data from August showed up to 12.2% weight loss at 13 weeks. Up to 97% of treated patients achieved at least 5% weight loss versus 10% on placebo. Up to 80% achieved at least 10% weight loss versus 5% on placebo.
Those placebo-adjusted effects are enormous. And here's why oral matters so much commercially. Injectable GLP-1s require cold chain logistics, pen devices, patient training, and ongoing prescribing friction. An oral pill eliminates all of that. It opens up primary care prescribing, international markets, and patient populations that will never accept a weekly injection. That's why oral GLP-1 is seen as potentially a $10 billion plus market of its own.
Then VK2809 for NASH and MAF-LD. Phase 2b Voyage had positive 52-week histologic data. Up to 85% of patients saw at least 30% liver fat reduction, with liver fat reductions up to around 55% in some cohorts. And management is in partnership discussions with large pharma on this asset, which could bring in non-dilutive capital.
Non-dilutive capital in a pre-revenue biotech is gold, Hudson. It extends runway without issuing shares. If Viking inks a NASH partnership in 2026, that's a meaningful positive for the whole story. And then VK0249 for X-linked adrenoleukodystrophy, Phase 1b is complete, showed safety and significant reductions in very long-chain fatty acids versus placebo. XLD is a devastating pediatric and young adult disease. This is a real optionality asset.
So what does the street think about all this? Because the sell-side view here is striking.
It is 17 buy ratings, 1 hold, 0 sell. That is near universal bullishness. H.C. Wainwright buy, Needham buy, Morgan Stanley overweight, Goldman Sachs buy, Cantor Fitzgerald overweight, Stifel buy. These are serious research shops. Median 12-month price target sits at $96. High end is $125, low end is $35.
And Q4 2025 reported EPS came in at negative $1.38 on February 11th. The forward EPS projection for Q1 2026 is negative 95 cents. So the street is modeling continued losses, obviously, but they're signing off on the pipeline value.
And that's the central tension I keep coming back to. Stock at $33.61, analysts at 96 median. Either a large group of well-resourced analysts are collectively wrong, or the market is discounting the pipeline more aggressively than the fundamentals warrant. My read is that the market is pricing binary risk. The Phase 3 could fail, and if it does, the stock drops 60 to 80%. That risk is real. But the analysts are weighing the expected value across outcomes, and they see asymmetry.
Let's build out the bull case explicitly. Number 1, Vanquish 2 Q3 2026 data. If positive, Viking files an NDA for the T2D plus obesity indication and becomes a near-term commercial stage company. Number 2, oral VK2735 progressing to Phase 3. If the oral matches the injectable efficacy in Phase 3, that's potentially a $10 billion plus product standalone.
Number 3, M&A optionality. Pfizer and AstraZeneca have publicly acknowledged they need obesity pipeline depth. Viking, with both injectable and oral dual agonist assets, is uniquely attractive takeout material. Number 4, the VK2809 NASH partnership, which provides non-dilutive capital and validates the non-GLP-1 pipeline. And number 5, Vanquish 1 data in 2027, the 4,650 patient pivotal. That's the crown jewel trial and the gateway to full commercial graduation.
Now the bear case, because this is a real biotech and we have to be honest about risk.
Number 1 is the binary clinical risk. phase 3 failure in Vanquish 2 would mean a 60 to 80% stock decline, potentially more. That is the single biggest risk in the entire thesis. Number 2, the GLP-1 giants. Lilly and Novo Nordisk have a 5+ year head start, established manufacturing capacity, existing physician relationships, and brand equity. Even if Viking's drug works, selling against Mounjaro and Wegovy is not easy.
Number 3, the oral phase 2 data, while impressive, had some dose response uncertainty. 12.2% weight loss was at the top dose. Phase 3 dose selection will matter enormously. Number 4, dilution. At $225 million a year in burn with Vanquish 1 still running, more equity raises are likely coming, especially if they want to fund a commercial launch.
And number 5, timing. Even if Vanquish 2 reads out positive in Q3 2026, commercial launch doesn't happen until 2028 at earliest. NDA filing, FDA review, manufacturing ramp, commercial build-out, that's years, not quarters. Investors need real patience.
Let's put Viking in context with its rivals, because this matters for valuation. Eli Lilly LLY sits at roughly $695 billion on market cap. They're the GLP-1 leader with tirzepatide, profitable, GAAP, revenue-generating dominant. Novo Nordisk, NVO at about $248 billion market cap, also profitable, semaglutide franchise. These are the elephants in the room.
Viking at roughly $396 billion market cap is a tiny fraction of those giants. That's either the opportunity, a clinical stage asset with dual GLP-1 GIP could command a massive valuation re-rating on approval, or the delusion, depending on how the binary plays. Among pre-revenue clinical stage rivals in the GLP-1 space, Structure Therapeutics, ticker GPCR, is at about $1.2 billion with an oral GLP-1 in phase 2. Altimmune, ticker ALT, is around $380 million.
So Viking commands the highest valuation among pre-revenue clinical biotechs in the GLP-1 race. Is that premium justified?
I'd argue yes, for a simple reason. Structure Therapeutics is single agonist oral. Viking is dual GLP-1 GIP, the same mechanism class as tirzepatide, which has delivered the best weight loss results of any approved drug. That mechanistic differentiation, combined with having both injectable and oral formulations, makes Viking genuinely unique. The premium reflects that, and the phase 3 progress reflects it too.
Let's talk options flow and institutional positioning, because this is illuminating. The put-call ratio isn't cleanly available, but what we can see is that implied volatility is elevated, and long-dated call option open interest in the $40 to $50 strikes expiring Q3 and Q4 2026 is dominating the options board. That tells you exactly what the smart money is doing, positioning for Vanquish 2.
And institutional ownership sits at 62.22% across 485 institutional shareholders. Top holders are Vanguard, BlackRock, and Fidelity, the standard large passive and active complex. That's meaningful institutional conviction for a pre-revenue name. Retail isn't driving this stock alone.
And on the insider front, we covered this earlier. CEO Brian Leon selling through 10b5-1 programs, CCO Neil Aubuchon buying at 33/50. Net insider ownership around 8.9% of shares outstanding.
So the bottom line, Viking Therapeutics is a classic show-me story. The pipeline is the product. The phase 3 data is quite literally the company. Everything hinges on Vanquish 2 in Q3 2026, and then Vanquish 1 in 2027. This is binary, and investors need to own that honestly.
If it works, the $96 median analyst target looks conservative. Viking becomes an NDA filer, a commercial stage company, and an obvious M&A target for any large pharma that wants obesity pipeline depth. If it fails, this is a clinical stage biotech that just lost its lead asset, and the downside is severe. Who belongs in this stock? Investors with high risk tolerance, at least an 18-month horizon, and genuine belief in the GLP-1 thesis.
And I'd add, investors who can size the position appropriately. This shouldn't be 20% of anyone's portfolio. This is an asymmetric but risk-managed piece of a diversified book.
Brian Leon put it well himself. He said, quote, "We believe the oral formulation of VK2735 has the potential to be a game changer, offering patients the efficacy of an injectable with the convenience of a once-daily tablet. The obesity epidemic is the largest medical market of our era. VK2735 doesn't have to beat Ozempic, it just has to find its place. The oral pill is the differentiation. If Phase 3 confirms what Phase 2 showed, we're looking at a completely different company. Learn more at chargedalpha.com.
And before we sign off, the important stuff. Everything you heard today is for informational and educational purposes only. This is not financial advice and should not be construed as a recommendation to buy or sell any security. All investments carry risk, including the risk of total loss. Viking Therapeutics is a clinical stage company with no product revenue. Clinical trial outcomes are inherently uncertain. Consult a qualified financial professional before making any investment decisions. Thanks for listening, everyone.
We'll see you next time on Charged Alpha.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.